Well, you're watching Mining Metrics on mining.com. Now, gold is holding firm near $3,390 an ounce, buoyed by safe haven demand and renewed bets on federal rate cuts. Silver has outpaced gold this year, hitting a 13-year high above $36. Mining stocks are climbing too, with the Van Eck Gold Miners ETF up 2% today. And while broader markets edged lower on global tensions, metals remain the bright spot. Well, let's bring in TD Securities analyst Daniel Ghali. Daniel, thanks very much indeed for your time.
Yeah, absolutely. Thanks for having me.
Now, Daniel, silver has jumped about 5% or even more over the past week. I mean, what's fueling that sharp move beyond the usual gold lag along?
Yeah, you know what's interesting is silver prices broke through $35 an ounce. And that's interesting because the last time it broke through $35 an ounce, it only took about 6 weeks to trade $50 an ounce. Right? There's a lot going on in the silver space. We've been highlighting a silver squeeze you can buy into thesis, which essentially related to the fact that the threat of tariffs was going to drain a large pool of the silver that is freely available for purchase in London as it flows through to the United States. That has happened. The surprise factor there has been that bullion has been exempt for tariffs. So theoretically, this silver could just easily flow back to London. But we are now in what I'd say is a suboptimal equilibrium where New York inventories are ample, London inventories are so scarce that they are detrimental to the market structure, and neither one of those jurisdictions is properly pricing that. So this suboptimal equilibrium, in our view, is a function of the financialization of silver as a real asset. It's a function of the fact that we don't think London markets are going to replete without some form of scarcity or constraints on physical availability. That is really the mechanism by which London will replete until such a time that we see some form of a squeeze. This dislocation will remain in silver markets and will fuel higher prices.
I suppose it does answer my second question to some extent, and that was, do you see silver's strength as sustainable, or are we nearing a speculative top?
Yeah, so here's what's interesting, right? We maintain our strategically bullish view on silver. To answer you directly, what's interesting is that the breakout north of $35 an ounce was almost entirely speculative led. It was a futures-based rally. It's very hard to see any catalyst, any macroeconomic event that had led to that increase in speculation. But what is interesting is that it doesn't really matter, because ultimately it can change the market psychology and attract more inflows into physically backed ETFs, which that in and of itself will have some reflexivity to the upside, because you continue to drain metal directly from the free float.
Right, now, gold's nearing record highs again. And of course, whenever this sort of thing happens, you try to want to just attach a story or some pattern there. But I mean, is this purely a rate cut story again at this time, or is there more at play here?
Yeah, it is not, right? Rate markets are not anticipating a significant amount of rate cuts on the horizon. So I don't think gold markets are either. What we think really the market is missing is that most of the rally so far this year in gold has nothing to do with the traditional drivers. It has little to do with the day-to-day movements in the US dollar, little to do with the day-to-day movements in US rates, little to do with the day-to-day movements in risk assets. What it is a function of currency management. And essentially, what we've highlighted is that gold is not only the premier safe haven asset, but increasingly is capturing a portion of what the US dollar is losing as a store of value. And so the entire world is seeking to hedge itself against that macroeconomic force, and gold is really the one driver that they can count on.
Daniel, the US and China framework deal included rare earths, but left the key export controls in place. How is that shaping supply risk sentiment in the market right now? I mean, from where you're watching this, there has to be an influence.
Yeah, I think the primary influence there is simply the information that it gives us with respect to what the US and China are trying to do. I think all of the information we've seen so far is that they're trying to avoid an abrupt decoupling, and instead are trying to move towards a slow decoupling. And that is positive for risk assets. It still doesn't provide much assurances for the US dollar's role as a store of value, and therefore it is not detrimental to the gold story.
There's growing chatter around possible US tariffs on copper, as I'll let you go here. Are traders starting to price in a structural supply shift, or is this a speculative noise? And again, I just want to focus on copper for a moment.
I think it's a little bit of both, right? There isn't much information that the market has with respect to when these tariffs are coming. The expectations were that we would have some information by mid-June. We are around this period of time, and we still haven't heard much. What is happening in copper markets, though, is that the US and China are competing for metal, and the world's primary venue for trading physical copper has very little remaining in its inventories. So physical copper is actually extremely scarce today, and this competition to source raw materials from China and the US is draining it further.
All right, we'll leave it there. Daniel Ghali, thanks very much indeed for talking to us.
Absolutely. Thanks so much for having me.